This is Nightly Business Report with Sue Herrera and Bill Griffith.
10 years later, investing is a lot different today than it was during the financial crisis, but risks still exist and there are ways to spot trouble. Network drama, one of the most powerful media executives in the country, is out of a job after more women accuse him of sexual misconduct. Taking a detour, Ford stock is at a multi-year low, and the plan to reinvent the automaker remains a mystery. Those stories and more tonight on Nightly Business Report for Monday, September 10th. Good evening, everyone, and welcome. Bill Griffith is off tonight. It was a dreary, rainy Monday on Wall Street, and today's trading session pretty much felt the same. Stocks started higher, then they drifted lower and meandered between gains and losses. In the end, the S&P 500 and the NASDAQ snapped their four-day losing streaks. The Dow Jones Industrial Average, however, fell 59 points to 25,857. The NASDAQ was up 21, and the S&P 500 added 5. This week also marks the 10-year anniversary of the financial crisis. Mike Santoli takes us back a decade to remind us that even if you had the stomach to buy stocks then, the road back was very bumpy.
Even before Lehman Brothers collapsed and before the full financial crisis and bailouts unfolded, stocks were already in a bear market. By the Friday before Lehman's failure 10 years ago this week, the S&P 500 had fallen more than 20% in just under a year. Bank stocks were cut in half, and a recession was underway. In other words, it was a time when disciplined long-term investors might consider investing more in stocks on the idea that they already reflected plenty of bad news. As it turns out, this idea would have been sound, but the timing awful. The S&P since the eve of Lehman's bankruptcy is up 130%, or an average of 11% a year, including dividends. That performance is right in line with the market's historical rate of return over the past century. So in this sense, after a decade, an investor was not penalized for buying stocks on the precipice of a global panic. But this move was painful for a long while afterward. The S&P gave way after Lehman fell, ultimately losing another 40% over the next 6 months into March of 2009. Even once the market had bottomed, the recovery was fitful and anxious. Even 3 years later, the broad stock market had not fully returned to pre-Lehman levels, and the European debt scare threatened to cause a financial crisis relapse. And of course, it took an extraordinary effort by governments and central banks to support markets since 2008. Among the lessons of this experience, over the span of a decade or more, the market usually bails out bad timing by investors, but that doesn't mean it's easy or comfortable along the way. For Nightly Business Report, I'm Mike Santoli.
Now, if you compare 2008 to 2018, a lot has changed for investors when it comes to trading stocks. Bob Pisani looks at just how different things really are.
10 years after the Lehman bankruptcy and the height of the financial crisis, the stock market's a very different creature than it was in 2008. Here's a few ways the crisis profoundly changed stock trading. First, the IPO market shrank. The drop in the markets and the regulatory rules created under the Dodd-Frank set up laws made it tougher for companies to go public. So excessively low rates also made it easier for private equity to raise capital and keep companies private. Second, there are far fewer publicly traded companies than there were 10 years ago. Fewer IPOs, more M&A, and more companies going out of business have led to a big drop in the number of public companies. So the number of publicly listed stocks fell dramatically after the dot-com bust. That was in 2000, from roughly 7,000 in 1998 to about 5,000 in 2004. And it dropped again after the financial crisis. Today, the Wilshire 5000, supposedly a basket of the 5,000 largest stocks in the United States, has only about 3,400 stocks in it. That's less than half the number there were in 1998. Third important point, sort of the death of volatility. Central banks helped create the greatest trade of the post-crisis era. Go long equities and short volatility. Bet things would be calm. Keeping rates excessively low for long periods of time helped create abnormally low volatility, punctuated by short bursts of panic. Fourth and most important was the crisis sped up the transition toward indexing and the rise of ETFs, exchange-traded funds. The ETF trend started before 2008, but it fit the investing post-crisis psychology very well. Many investors came to believe that by not taking individual stock risk and using ETFs, they might be able to reduce their risk. Well, that's debatable. Either way, we know the ETF trend started pre-2008, but it accelerated after the crisis. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The ongoing concern, of course, is the potential for another crisis. Former Fed Chair Ben Bernanke, along with former Treasury Secretaries Timothy Geithner and Henry Paulson, have written an op-ed. All said that in some respects, reforms have helped the market become more prepared for the next crisis. But the three also say that Congress took away some critical tools used by regulators in times of crisis, and they are urging lawmakers to bring them back. Well, this morning, former Federal Reserve Governor Daniel Tarullo echoed those sentiments, saying that he thinks the financial system is much safer today than it was.
Largest financial institutions, they're obviously substantially safer than they were 10, 12 years ago. Capital levels are up. Their funding is much more stable than it was. Their risk management is immeasurably better than it was. Those gains, though, of course, are not locked in for eternity. They requires vigilance on the part of the regulators and the supervisors.
Mr. Tarullo oversaw financial regulation at the Federal Reserve until last year. So how have things changed? Have they gotten better for investors since the financial crisis 10 years ago? And what can you do now to protect yourself against a future crisis? Chris Zaccarelli joins us to discuss that. He is the Chief Investment Officer with independent advisor Allianz. Chris, welcome. Nice to have you here.
Thanks for having me.
You know, Bob outlined some of the changes to the market and the structure of the market, but what do you think are the biggest changes that have made the markets safer for investors?
Well, for me, if you look at what the financial system has done since that time, it's gotten a lot safer. The banks have a lot bigger capital buffers, which means they've got more cash on hand to withstand the next crisis. The Federal Reserve and other central banks have gotten a lot more interested in what's happening within financial markets. And in fact, they run stress tests annually in order to make sure that they can simulate what happened 10 years ago. If it were to happen again, that banks could make it through that crisis. So those three things really help to improve the stability of the financial system and should make the system safer for investors.
You know, though, every crisis is different. You know, they never repeat. They're never exactly the same. It would be easy to protect yourself against them if they were, but they're not. Bloomberg, for instance, this morning posed the question whether or not student loan debt is the next bubble to burst in the next crisis. So as an individual investor, are there some basic things you can put in place to safeguard your portfolio against a looming crisis that you may not be able to recognize immediately?
Yes, absolutely. I mean, one of the best ways to protect yourself as an investor is to be diversified. So to make sure that you don't have all of your money in the stock market, you want to have a nice mix of stocks and bonds. You want to make sure that the stocks you're invested in are balanced across large cap equities, mid cap equities, small cap equities, and you want to look at international stocks as well for some diversification. That diversified portfolio is typically going to hold up a lot better under a number of different scenarios, and that's really the best way in advance of a financial crisis to make sure that you're protected. Again, not being 100% equities is the most obvious way, but further diversification can really help you.
Do you think the onset of the popularity of ETFs, to Bob Pisani's point earlier, has that made the market safer? Are investors safer using ETFs than individual stocks? Or are they basically a proxy for individual stocks?
Well, I think ETFs are an interesting development, and clearly I think what you've done is you've transferred one type of risk for another. So for any individual investor, the fact that they don't have a smaller number of stocks and they're more diversified in terms of their ETFs probably will help each individual. But in the aggregate, you still have just as much money in the stock market, if not more, to the extent that you've got this false sense of security that ETFs will protect you and the market goes down 30 to 40%. It probably doesn't matter whether you have individual equities or whether you have ETFs, you're still going to experience some losses, and that could drive people to sell and create the same type of financial panics that we've seen in the past.
All right. Well, hopefully we won't be talking about a crisis anytime soon. But Chris, thanks for your advice. Chris Zaccarelli with independent advisor Allianz. Well, the leading man at CBS is out. Longtime CEO of the network, Les Moonves, resigned from the company. This after more allegations of sexual misconduct surfaced. The stock fell in trading today as investors wonder about the future of the Tiffany network. Jane Wells is in Los Angeles tonight.
You know what? I'm very hands-on. I genuinely respect the people I work with.
It's the end of an era. Just 10 months ago, Les Moonves was at the top of his game, the highest paid CEO in media, leading the #1 network in America, and here explaining his management style.
I've been an employee, and I know what it feels like to be an employee.
But it was the stories of former employees going back decades which brought Moonves down. He was already negotiating an exit package worth potentially $140 million after a New Yorker story 6 weeks ago told tales of sexual harassment, assault, and retaliation. But after a second story on Sunday, negotiations turned into an immediate departure. Moonves leaves without any severance pending the outcomes of 2 outside investigations into his conduct, though Forbes lists his current net worth at $700 million.
The clear winner is Sherry Redstone, who runs National Amusements, which owns most of CBS and Viacom. She had been battling with Moonves over whether to merge the 2 companies. She wanted to, and he didn't. And CBS and National Amusements ended up suing each other.
As part of the Moonves exit, the lawsuits go away, and Redstone will hold off any plans to merge for at least 2 years, unless the new board at CBS decides a sale or merger would benefit the company. And, oh yeah, also new, half the board has been replaced with outsiders, with media veterans like Dick Parsons, and nearly half the members are now women.
This is really hard. It is. This is hard for everybody at CBS News.
On CBS This Morning, anchor Norah O'Donnell found herself in the same position she was in 10 months ago when co-host Charlie Rose was fired.
Women cannot achieve equality in the workplace or society until there is a reckoning and a taking of responsibility.
Moonves denies he forced himself on anyone and that the allegations are, quote, inconsistent with who I am. A search for a new CEO is on as COO Joe Iannello steps into the job, at least for now. But 11 months after the Me Too hashtag was created, of all the high-profile people out of a job, the first CEO of a Fortune 500 company has fallen in this new era. For Nightly Business Report, Jane Wells, Los Angeles.
The man who ushered in a new era for the Chinese internet industry is stepping back. Jack Ma, who turned Alibaba into one of the world's biggest companies, will resign as chairman in a year. That sent the stock lower in trading today. Eunice Yoon has more tonight from Beijing.
Jack Ma chose a special day to unveil his succession plan. It's his 54th birthday, and it's Teacher's Day in China. So people on the social media have been congratulating Teacher Ma and saying that he chose this day because he wants to return to life as a teacher. So Alibaba will have a new chairman 1 year from today. Ma will stay on during the transition, and he'll finish his term as an Alibaba board member until the AGM in 2020. Ma will hand the reins to CEO Daniel Zhang, and Zhang joined Alibaba in 2007 and had several different hats. As the CFO of the hugely popular online shopping site Taobao, he was the president of Tmall, the site for branded stores, and he was COO. He's also been credited with making Alibaba's Singles Day shopping festival the big bonanza that it is today. In his letter to shareholders, customers, and others, Ma praised Zhang for his analytical mind and said Zhang holds dear Alibaba's mission and vision. But the big question for investors, as it would be for any company with a dominant founder, is what is Alibaba without Jack Ma? Ma is the visionary of Alibaba. He's the big think guy, the elder statesman of the company, not only for the company, but the entire Chinese tech scene. And analysts have been describing Zhang as a solid manager, cautious, and a man who doesn't crave the limelight. So he does have very big shoes to fill, and perhaps to ease investors' concerns, Ma addressed that question in his letter, saying, "The one thing I can promise everyone is this: Alibaba was never about Jack Ma, but Jack Ma will forever belong to Alibaba." For Nightly Business Report, I'm Eunice Yoon in Beijing.
It is time to take a look at some of today's upgrades and downgrades. Dow component United Health was downgraded to neutral from buy at Citi. The analyst cites concerns about the commercial risk market and sees limited upside to estimates. The price target is $288. The stock fell 3% to $259.73. Darden was downgraded to neutral from outperform at Baird. The analyst cites the stock's recent strength and says it may be overextended in the short term. The price target is $120. The stock fell a fraction to $118.68. Foot Locker was upgraded to outperform from market perform at Wells Fargo. The analyst cites improvement to the assortment of Nike products and fewer headwinds in Europe. The price target is $58. The stock rose 5% to $49.09. Still ahead, looking for a job at a startup? There are a few things that you need to know. House Republicans released their plans for a second round of tax cuts. The legislation proposed by the House Ways and Means Committee would make the lower individual rates permanent, eliminate the maximum age for some contributions to retirement accounts, and allow for new business write-offs. Airlines are waiving change fees as Hurricane Florence threatens to impact travel. The storm is now a Category 4, and it is strengthening. It looks increasingly likely it should make landfall along the mid-Atlantic coast a bit later this week. The governor of South Carolina has ordered more than 1 million residents to evacuate. The governor of Maryland has declared a state of emergency. Southwest and American Airlines were the first to waive some fees, and the other carriers are expected to follow. Insurance stocks were also lower, especially those with exposure to North and South Carolina. Volvo is dropping its IPO plans, at least for now. The automaker's parent company, Geely, is blaming global trade tensions and a downturn in automotive stocks. Volvo and its Chinese parent had been discussing an offering to value that car maker between $16 and $30 billion. And Ford shares are languishing near a 9-year low. That is partly due to the growing uncertainty surrounding the automaker's future. Phil LeBeau has more on the questions swirling around Ford.
For more than a century, Ford has reinvented itself. Now CEO Jim Hackett is trying to do it again, but his game plan remains a mystery.
The real question is there more going on behind the scenes and under the surface than is apparent in the quarterly earnings?
Ford is still profitable, thanks largely to the F-Series pickup truck, the best-selling vehicle in the U.S., on pace to have a record year. But Ford is also struggling to grow profits in Europe. Sales in China are down, and it's investing heavily to develop self-driving vehicles. For more than a year, Hackett has talked about restructuring Ford, and the company plans to spend $11 billion to become leaner and more financially fit. Many expect Ford to cut thousands of jobs, but exactly how many and where remains anyone's guess.
Costs build up, market positions weaken, and you need an outsider to come in and shake things up. Question we have after over a year now with Mr. Hackett, is he the right one to do it?
A decade ago, Alan Mulally reinvented Ford by selling niche brands like Jaguar, shutting down the Mercury line, and focusing on growing the Ford brand. That brand still has plenty of cachet, especially when it comes to building trucks. But in other parts of the business, like developing electric cars or self-driving vehicles, Ford is viewed by many on Wall Street to be struggling. Changing that perception will depend on Jim Hackett's turnaround plan. Phil LeBeau, Nightly Business Report, Chicago.
Weight Watchers is bulking up, and that's where we begin tonight's market focus. The company is being added to the S&P Mid-Cap 400 index starting next Tuesday. It will replace KLX, which is being acquired by Boeing. Its inclusion sent the stock up 4% to $69.57. Shares of Accorda Therapeutics tanked after that company lost a patent appeal in federal court. The ruling upholds a previous ruling invalidating 4 patents for its multiple sclerosis drug, opening the door for cheaper generic drug competition. The shares lost nearly a quarter of their value, closing at $20.80. Snap's chief strategy officer is stepping down. It is the latest top-level executive departure following a controversial app redesign, which led to a drop in users. Snap is the parent company of Snapchat. Snap fell 2% to $9.74. Shares also hit a 52-week low during the day. And Sonos came out with its first earnings report as a public company, and it was not music to investors' ears. The maker of smart speakers for the home lost 45 cents a share. That's about double what Wall Street was expecting. Revenue was in line with estimates, but down 6% from a year ago. Sonos went public last month at $16 a share. Today, they actually finished the regular day up 13% to $21.24, but that was initially wiped out almost immediately following the earnings report that came out after the bell. As we've been reporting, the U.S. job market showed solid growth last month, and startups have played an important role in that growth. While they account for only 2% of total U.S. employment, according to research by the St. Louis Fed, startups make up a significant portion of net job creation. So, how can you land a job at a startup? Our senior personal finance correspondent, Sharon Epperson, joins us now with some tips. It's great to see you.
Good to be here.
All right, so there are a wide variety of startups. You've done all this research for us. Are there certain startups that you should look at rather than others?
Well, the first thing is how you define the startup really depends on who's making that definition. Sometimes it could be a startup has been around less than a year, maybe it's up to 5 years, maybe even a little bit longer. But I decided to look at LinkedIn. They just put out a report on the best startups to work for according to some criteria that they had. Companies that are 7 years or younger, that have 50 or more employees, that are privately held in the U.S., and ones that have significant employment engagement and that a lot of LinkedIn users are looking at. And the number 5 company was a company called Bird, and that's an electric scooter company. It's now in 30 cities. And the next one is Noodle AI, an AI company. Also on there, you got to have some of the Bitcoin craze, right? So Coinbase is one that they're looking at there, and that's been growing 20 million accounts and also expecting to double its headcount. So job seekers are very interested in that. Halo Top Creamery, which I see in the grocery store all the time, the ice cream company that is now the #1 selling ice cream in American grocery stores.
Wow.
That's supposed to be another great startup to work for. But no surprise probably to many people that the #1 startup to work for, according to this year's LinkedIn report, was Lyft. With all that they're doing, of course, with scooters and bicycles, as well as cars with ride sharing, but also in terms of employees offering mental health benefits to many of their employees and having over 3,000.
There you go.
So a lot of folks that I've been talking to, venture capitalists, say this is what you want to look for. Companies that have 100 or more employees means they're probably off to a pretty good start already. You won't be doing everything for everyone. You might have a little bit more mentoring, a little bit more guidance, and that's something to keep in mind.
So what qualities, I know it depends on the company, certainly, but in general, what qualities are they looking for, and how do you get that on your resume to get that first interview?
Well, you want to be self-motivated, you want to be driven, you want to be a multitasker, but also be a team player because you're going to have to be working with a lot of different people, and understand that not all startups are successful. Understand that you may have to take some risk and make sure you have some tolerance for that.
All right. On that note, Sharon, thank you so much, as always. Sharon Epperson with us tonight.
My pleasure.
Coming up, the art of the deal is taking on a whole new meaning in the art world. As we've been reporting, the White House is threatening additional tariffs on Chinese imports into the U.S. And there's an unusual industry that could get rattled by the trade dispute between the world's 2 largest economies. Robert Frank has the details.
The last page of the China tariff list contains a surprising entry, quote, paintings, drawings, and pastels executed entirely by hand, whether or not framed, as well as sculptures and any antiques exceeding 100 years. In other words, Chinese art and antiques would be subject to a tariff if the next list takes effect. It doesn't matter how old the pieces are or what country you buy them from. So if you are a New York collector and you buy a Chinese vase from a London dealer, that vase would be subject to a 25% tariff because hundreds of years ago, it was made in China. Now, the U.S. imported about $300 million worth of Chinese art last year, much of that from Europe. But galleries, dealers, museums, collectors, and auction houses say the tariffs would hurt the U.S. and help China, which wants to dominate the business of buying, selling Chinese art and to keep all the treasures in their own country. Tariffs would shift both back to China and cause many American galleries and dealers to shut down.
would have a very severe impact. I'd have to question how I could go forward under those circumstances. We cannot make these things. There's no one manufacturing it, and it's going to severely harm my clients and me as to trying to continue to do what we do.
Sotheby's and Christie's recently sent a letter to the U.S. trade rep saying, quote, the vast majority of Chinese artwork imported into the U.S. comes from other countries, and that putting tariffs on art from China would not result in an increased demand for American-made art. Antiquities and ancient Chinese art make up the bulk of the market right now, but demand for work by living Chinese artists has soared in recent years. Galleries say tariffs would hurt their work.
Absurd. Now, of course, I'm the guy that gets affected, so I know I'm a totally biased person, but it takes very little analysis to see, how absurd and self-destructive a blunt instrument like tariffs are. This is an appreciating asset, so it would be like putting a tariff on stocks.
This week kicks off Asia Week in New York with millions of dollars of Chinese works, both old and new, being bought and sold. And for now, the tariffs have actually helped sales, with collectors rushing to buy and artists rushing to sell before the tariffs take effect. That show at the Pace Gallery, well, it's sold out in just 25 minutes. For Nightly Business Report, I'm Robert Frank.
And before we go, here's a look at the final numbers from Wall Street. The Dow fell 59 points to 25,857. The Nasdaq was up 21, and the S&P 500 added 5. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining me. Have a great evening. We'll see you tomorrow.